Let's just jump right in, because today we're tackling something that honestly makes a lot of people sweat. But it is absolutely crucial if you want to build and, more importantly, protect your wealth. We're unpacking the millionaire blueprint for surviving and actually thriving during market crashes. We've taken some really fascinating insights on how the wealthy navigate economic downturns and distilled them all into this explainer. That way, you'll know exactly what to do when the markets inevitably turn red. So let me ask you something right out of the gate. Seriously, think about it for a second. What do you really think highly successful millionaires do when they hear scary words like market crash, recession, bear market, or just general economic uncertainty? Do you picture them scrambling around, calling their brokers in a total panic? You know, for most beginners, the gut reaction is pretty simple. Panic, sell, and hide. When prices are tanking, the news is screaming doom and gloom, and your social media feed is basically drowning in fear. The most natural human instinct in the world is to sell everything. Just hide your money under the proverbial mattress before things get even worse, right? But here's the thing. Successful, long-term investors take a completely counterintuitive approach. They don't react to the crash because they've literally been preparing for it for years. All right, let's get into Section 1, Panic versus Preparation and Expecting the Inevitable. You see, there's this massive psychological divide between beginners and pros. Beginners, they act totally shocked every single time the market drops. It's like, oh no, the market is broken, this shouldn't be happening. But contrast that with the millionaire mindset. To them, a crash isn't a surprise at all. It's expected. It's just a completely normal part of the economic cycle. They know for a fact that every single market cycle includes periods of fear, economic slowdowns, and temporary panic. It's happened before, and you better believe it will absolutely happen again. Which brings us to a huge foundational rule. Millionaires don't build plans around perfect conditions. They build incredibly resilient plans, specifically designed to survive the difficult conditions too. And guys, that is a massive mindset shift. Because if your financial plan only works when the sun is shining and stocks are going straight up, well, you don't really have a plan, you just have a wish. To really wrap your head around why this matters, just imagine waking up tomorrow and seeing a sudden 30% drop across the board. Gut-wrenching, right? If you aren't prepared, a crash like that dictates your entire life. But if you have true financial flexibility, it doesn't mean the end of the world. In fact, it might actually represent a massive opportunity. But the catch is, you literally cannot seize that opportunity without doing the groundwork first. Moving on to Section 2, the financial foundation, preparing the ground. Listen, financial flexibility is the whole ballgame. Take investor A. They are completely tapped out, fully invested. Every single dime is tied up. So when that 30% drop hits, they're forced to basically just sit on their hands and watch their portfolio bleed. But now look at investor B. They were smart. They kept some cash reserves available. When the market tanks, they aren't trapped at all. They have the ability to step right in and buy high-quality assets at significantly lower prices. They have the dry powder ready to go. Now, if you want to be like investor B, you've got to build these pillars of financial stability way before you start worrying about massive profits. We are talking about having robust emergency funds, tightly controlled debt, and really healthy cash flow. Why is this so critical? Because when your personal finances are weak, like if you're living paycheck to paycheck or you're drowning in high-interest loans, every single market decline is going to feel like a devastating personal crisis. You'll be forced to sell your investments just to survive. But when you have that rock-solid foundation of financial security, you can actually make calm, logical investment decisions instead of desperate ones. So remember this phrase, sometimes cash is optionality. I know, a lot of newer investors feel like holding on to uninvested cash is just throwing money away to inflation. But in the Millionaire Blueprint, cash is a remarkably powerful tool. It gives you choices exactly when everyone else is running out of them. That takes us right into Section 3, Quality and Diversification, Surviving the Storm. Because here's the harsh reality. When fear hits the market, the weak just get absolutely crushed. We're talking companies with heavy debt, weak profits, terrible management, or just fragile business models. They suffer immensely, and a lot of the time they face bankruptcy. Millionaires know this, so they fiercely focus their portfolios on strong companies. They're looking for ironclad balance sheets, consistent earnings, and really durable competitive advantages. During a crash, survival is literally the only thing that matters. And the strong businesses, they don't just survive, they actually end up capturing all the market share left behind by the weak guys who didn't make it. So when the dust finally settles, the strong bounce back much, much harder. But hey, even strong companies hit speed bumps, which is why we absolutely have to talk about the danger of one. It is incredibly dangerous to put everything you have into one stock, one industry, or just one single idea. If that one idea fails, boom, your entire portfolio takes a catastrophic hit. It's honestly one of the oldest rules in the book, yet beginners ignore it over and over again because they're chasing that one quick payout. And that right there is exactly why millionaires obsess over diversification. They aren't spreading out their risk because they're scared of investing. They do it to strictly reduce the impact of being wrong, because they understand that future uncertainty is absolutely guaranteed. Think about it. Nobody knows exactly what's going to happen next, and every single investor is wrong sometimes. Diversification is just your safety net against your own blind spots. All right, let's jump to section 4, mastering investing discipline, the mental game. Let's be real. Market crashes are intense, highly emotional events. Prices are plummeting, predictions get completely extreme, and fear, it spreads like wildfire. So your ultimate defense mechanism here is logic over emotion. When the crowd starts making all these panicked, knee-jerk decisions, successful investors deliberately do the exact opposite. They slow down. They meticulously review the cold, hard facts, and they follow the plan they created way back when times were actually good. Because they know that emotional decisions made during peak fear almost always create permanent long-term damage.
Applying that logic completely shifts their timeline too. See, beginners usually get trapped in the panic horizon. They're obsessing over the next few days or weeks. But successful investors, they zoom out. They focus on years, evaluating if a business is still going to be dominating 5 years down the road, or even decades, asking themselves if the long-term story of an entire industry is still intact. Because if that core long-term story hasn't changed, a temporary drop in a stock price suddenly looks way less terrifying and a whole lot more like a massive discount.
And here's a really cool part. No matter how much money they've made, successful investors are always running this continuous learning loop. Because let's face it, crashes have a really nasty way of painfully exposing your weaknesses, whether that's poor risk management, getting overly emotional, or just plain old overconfidence. Millionaires use these painful periods as masterclasses. They study exactly what happened, they pinpoint what worked and what spectacularly failed, and they immediately improve their strategy for the next cycle. They literally never stop learning. A massive part of that learning curve is just accepting reality. Timing the market perfectly is extremely difficult. Actually, scratch that, it's practically impossible. There's this huge beginner myth out there that successful investors somehow magically predict the exact bottom of a crash so they can buy in at the absolute lowest penny. They don't. Waiting around for perfection is just a fool's errand. Instead, millionaires play the probabilities. They gradually invest over time, and they stay incredibly disciplined rather than just gambling on exact predictions. Which brings us to our final part, Section 5, Reframing the Crash, Seeing Opportunity. So the standard everyday view looks at a sea of red numbers and panics, thinking, oh my gosh, everything is falling apart. But the millionaire view, the one backed by a rock-solid foundation, cash reserves, and serious emotional discipline, they look at that exact same event and ask, okay, what opportunities are being created for me right now? The very same event that paralyzes one person gives another person the absolute chance of a lifetime. Perspective really is everything. At the end of the day, it boils down to this. Preparation creates confidence. Honestly, nobody, not the talking heads on TV, not the smartest analysts on Wall Street, nobody knows exactly when the next crash is going to hit. But the secret is, you don't need to predict every storm. You just need to be prepared to weather it. Wealth isn't built by magically dodging every market decline. It's built by surviving them, learning from them, and taking decisive action when everyone else is completely paralyzed by fear. So, I want you to ask yourself this right now, and be really honest. If the market crashed 30% tomorrow, would you be ready? Take a hard look at your foundation, your portfolio, and your mindset. It's time to shift from panic straight into preparation. Thank you so much for joining me on this explainer. I hope you got a ton out of it. See you next time.